Well, meantime, weak data today adding pressure to this market and piling onto this theme of uncertainty. So consumer sentiment worsened as inflation fears grew, and the Fed's key inflation measure came in higher than expected this morning, PCE. Joining us now is Claudia Sahm. She is the chief economist at New Century Advisors and a former economist at the Federal Reserve. And Claudia, it's always great to have you on. So definitely want to get your takeaway from the data, the disappointing data we saw today, especially in light of all the debates we've been having around soft versus hard data.
Yeah, this is tough. On the inflation data, it was yet another month that underscored a theme that frankly has been with us for several months, if not the past year, grindingly slow and uneven progress towards 2%. Right. And I think then we also remember we are in the early innings of what could be inflation picking back up. Today's inflation data might count as a good day when we get later this year. So I think that's what's also really disappointing is before a lot of these policy impacts are in place, we have inflation looking pretty weak. Inflation picked up, looks, strong. The consumer spending did not have the pop in February we were hoping for. So it's like you have a setup that isn't good. And then I think it's very rightly so that consumers look at this, business look at this, and you ask them, what do you expect for the rest of this year? And you do not get very positive answers back.
I mean, we got the FOMC meeting last week, and the big thing that came out of that essentially was the SEP and the dot plot and the economic forecasts. And as our own Steve Leisman has pointed out, what you saw if you read through some of the decisions that went into some of those forecasts is a tilt towards perhaps rising risks of stagflation. Are you in that camp?
Absolutely. That jumped out at me first thing in those summary projections. Normally when you do a forecast, and each Fed official gives us their baseline forecast for this year, and they maybe had a whiff of stagflation, right? But very minor. They're really pretty optimistic forecasts. And yet when you get down and ask them like, oh, how do you feel about the forecast? They're like, well, we're really uncertain, not pandemic level uncertain, but really uncertain. And then it's like, okay, so you think you might be wrong. Which way are you going to be wrong? And it is all so shifted towards we're going to be wrong with stagflation, lower growth, higher inflation, higher unemployment. And that skew, that imbalance, that was at the highest level that's been in those forecasts since they started in 2007. Normally, you'd move your forecast in that direction if you think you're going to be wrong that way. So, yeah, that was a pretty downbeat picture. And I think the Fed speak, the officials that have been out since the meeting, have underscored that pessimism.
And we've certainly had quite a bit of Fed speak, not only today, but all week. Muslim in particular, a couple days ago, getting a lot of attention for some hawkish commentary around tariffs and the potential impact there. So if we have an administration that's cutting government spending, or at least attempting to, if you aren't a Fed that's printing money right now, doesn't that help to ensure that any inflationary bump that we do potentially get from tariffs and shifts in trade policy, doesn't that help to ensure that it is in fact transitory, to use the word that Powell used last week?
So the tariffs have this stagflationary impulse, right? Like we talked a lot about how they could raise prices for consumers. They also cut into inflation-adjusted income, right? Because those prices are higher. So in some ways, that does some of the Fed's work, which you'd normally do with raising interest rates, right? Because you've got less growth, and that can hold back the inflation. It's a setup where the Fed's tools aren't. I mean, they can respond to this, but they're not really well set up for a stagflationary environment. So, but that absolutely is the question about, but they could do harm, right? If they cut rates deeply and that inflation takes off and gets stuck, obviously that is not the outcome that the Fed or anyone else wants either.
So finally, looking to next week, we get a jobs report next Friday and a lot of labor data leading up to it. What will you be watching for given this macro backdrop?
So I think as with the consumption inflation data today, we probably will get some hints of worse data to come, right? There have been some federal government layoffs. There have been some contract cuts that will probably make some imprint in the jobs data, but we are very much in early innings on that process. And so, it's kind of, we're getting a hint of what is to come, but we certainly shouldn't take a lot of comfort if, it looks like a good month, because these policies that we know are coming, we don't have them in the data yet.